Welcome to another episode of What's on Your Mind, a show hosted by the Institute of Trading and Portfolio Management, where we'll be talking to the Institute's senior trading mentors about what's been on their mind in the financial markets. I'm Chris Quill, and today I'm joined by Raj Malhotra and Chris Cathey. Now, as always, just to remind you guys watching, if you want to learn more about trading in general or more about what the Institute does, then please visit our website, itpm.com. From there, you'll be able to see a lot of different links to educational resources. So things like our upcoming live seminars. For example, we've got one in the Gold Coast, Australia on the 17th of November, one in London on the 22nd of November, and one in Florida on the 1st of December. We've also got bite-sized videos, our online video education, and links to our mentoring programs that we do around the world as well. So with all that being said, let's jump straight back into the show. And Chris, I think we'll start with you this week. It's been an interesting week as far as Brexit's concerned. So I was wondering if we could get your thoughts on that.
Yeah, great. It certainly has been. We had the news on Tuesday that the provisional deal had been agreed between Theresa May and the European Union, and subsequently been sort of okayed by the UK cabinet. Personally, I think it's very, very unlikely that this passes through Parliament, and I think there's a very high probability of us having a vote of no confidence in the UK government right here, right now, and subsequently another general election, which I think is going to be an absolute disaster for the country. And clearly, that's why the pound's down 1.5% this morning. Just to give you just to sort of keep where the numbers stack up, referendum was on the 23rd of June 2016. Article 50, so basically the exit takes place on the 29th of March 2019, so roughly around about 5 months ago. And just since the referendum, just give you sort of an idea about the performance of different UK assets. FTSE 100 is up around about 14-15%. FTSE 250, which is the mid-cap index, is up around about 16-17%. The pound against the dollar is down around about 12%, and the pound against the euro is down around about 14%. So clearly, big weakness in the pound, big strength in the equity markets. And just to put things in context, the FTSE 100, around about 3/4 of its earnings are outside the UK, so it's not particularly exposed to the UK domestic economy. FTSE 250 is around about 50-50 UK earnings versus overseas earnings, so clearly more exposed to the UK economy. And I think maybe a trade that we should be thinking about is looking to be, if they think this Brexit is going to be negative for the UK economy, clearly the trade would be to long the FTSE 100, short the 250, which is a trade I have on and looking to increase. Elsewhere in Europe, we've got two things to be aware of. I think that the Italian situation, which we talked about, seems to have gone very, very quiet. Still a to and fro between Rome and Brussels to okay the Italian budget. The spread of the Italian government bond over the German bond is around about 3%. It hasn't really moved that much over the last few weeks, but clearly the market's just waiting for new news. Just to sort of finish off in Europe, about German data out yesterday, so Tuesday, which is pretty negative. Looks at the rate of growth in the Eurozone is clearly starting to slow hard. And coupled with the fact that inflation now is above the ECB's target rate of around about 2%, and the ECB interest rate is zero. It's kind of like what happens now in Europe. Growth is slowing, inflation is picking up, and the central bank doesn't really have a lot of scope to do anything apart from quantitative easing, which I think is probably going to be less. It seems to be less effective every time it seems to be enacted. So quite a sort of a bearish outlook in Europe right here, right now. Well, let's see how everything plays out. But so should we move into the US? Anything going on your side of the pond there, Raj?
Yeah, absolutely. Yeah, so there's a lot going on over here, obviously.
Always, yeah.
Yeah, so if you look back to October, hedge funds had their worst performance I've seen in a long, long time. Many of them were down double digits. And what you're seeing is, I think, clear symptoms, not yet a full disease, but symptoms of what happens in the late stage of a bull market, which is that growth stocks, they just cannot hold the bid, whether it's in anything in tech, big and small cap tech, biotech, semis. There's just a growth. Any rallying growth just gets sold.
Yeah, absolutely.
And last in October we saw was the losers of the year, names like limited brands that were down. Had a big hedge fund short. It's down 50% from its top, from like 60 to like 25. Then it's rallied 50% from its low, from like 25 to 37.
That's pain. Yeah, that's the pain trade.
And now that those stop rallying, what's I've seen is a lot of the long only funds that have to own stocks are selling growth names, and they're buying the boring names, the names that like the P&G and the Procter, Coca-Cola, McDonald's, J&J. So in this rotation in consumer staples, that's generally the end of a bull market. And then from there, we'll see what happens. Now, I'm not convinced that it's over yet. I mean, I'm seeing technicals that think we're somewhat oversold in a lot of the leadership. But it's first time in the last 10 years, you're actually seeing fundamental bad news in big cap names like Apple. Absolutely. That's actually bad news. You haven't seen any. All the sell-offs in these names have just been technical or outside events. But this is an actual, a fundamental shift here. So
I agree.
If you have a long bias here, I definitely think you should be buying some quote-unquote cheap put spreads in whether it's SPYs or IWM. Obviously, the midterms came and gone. That went exactly as expected. Yeah. And here's actually a lesson from that. The first day it was a big rally. It was almost a riff rally, and in these events they tend to be a fade. Like with the first move tends to be the wrong move.
Yeah, absolutely.
And in 2016 election, the first inclination was to sell. Brexit, the first one was wrong.
Yeah, absolutely.
So that's a don't go. As this market gets harder, don't go just looking for reasons to trade. Like don't go trading off the California forest fires. Don't sell.
Yeah, exactly.
I mean, obviously, if you sold PCG, if you knew there's a fire, they're obviously always at fault. But don't go. Absolutely. But don't go try and buy in PCG here just because you think you're Johnny Cochran or Judge Reed. What liabilities are going to be. Like these things can go for a long time. Look at what the BP oil spill. The deep water thing. Everyone tried to buy that, catch that falling knife. So don't go buying that.
Catching a falling knife is crazy. Absolutely.
Yeah, exactly. And don't go buying lumber now just because of fire. Yeah, no shit. We all know that there's a fire.
Exactly.
Don't go buy Weyerhaeuser because there's a few trees burned down. That's not. There's fundamentals in that. Don't go trading off the news.
No, exactly.
Fundamentals.
Exactly. Actually, it's funny to say about politics. My own opinion about politics, unless it's a sizable shift, 95% of the time politics is completely irrelevant. I mean, the midterm elections as a whole, it gives everybody, the talking heads, an opportunity to sort of talk about noise, but it's completely irrelevant to the market. Absolutely irrelevant.
I'm not. I wouldn't go shorting banks because Maxine Dirty Waters is the new head of it.
Exactly.
She's not going to nationalize JP Morgan. I'll bet on Buffett over Maxine Dirty Waters any day.
Absolutely, man. So, actually, talking about the US, it does seem as though, looking at the leading indicators, that the rate of growth in the US is probably starting to slow a little bit. The PMI, NMI both came out a little bit weaker than expected. Consumer confidence still holds up, but building permits is clearly being weak. It continues to be weak. It's been weak all year. So we've got an interesting sort of, seems to me like an inflection point. And like you mentioned about the price action in the US market, it does seem as though in the very late stages of a bull market.
Yeah, it does. But I still think one sector that will stay strong for a while is the consumer, because historically that always lags. Consumer spending lags the stock market. Yeah,
that's the last thing to go. I mean, all year the apparel and retail sector's been pretty strong. Construction's been weak. I mean, a few trades that people are still looking to put on is long some of the retailers and short some of the construction names. I mean, Lulu and Costco have been two great names on the long side, and LPX and US Cement, both big underperformers on the downside, construction sector. You talk about these things that move 75% this year, 75, 85%. That's probably going to continue. I mean, it's going to have a breather, but I agree with you, consumer is probably the last thing to go.
Yeah, I mean, especially I think on the high end. I mean,
absolutely.
There's a lag effect. Like if you look at yesterday, actually, Harry Winston paid bought an $83 million diamond, the highest, most expensive diamond ever sold. So
$83 million.
Yeah. So thankfully that one's off the market to my girlfriend.
That's a relief. I thought I had Christmas taken care of.
Risk pool's already engaged now, so that one's also off the market.
Exactly.
So the rich will keep getting richer.
Definitely, rich get richer, the poor get poorer.
Thinking about actually this in a more sort of a more general question about this stuff, it's been a theme for the last few episodes in What's on Your Mind that we're kind of coming towards, or might be coming towards, the end of a bull market kind of cycle. So what is it that retail traders need to think about under those circumstances? Is it sort of reducing exposure? They might not necessarily want to go short straight away, right? So what are the things they can think about?
I think one thing to think about as we go into this market is just take your position size down, because if we are in a bear market, volatility tends to be higher, and so you can get the same return. You can get the same dollar return with a smaller position just because you will have bigger moves. So basically, cutting your position sizes in half makes a lot of sense to lower your daily P&L volatility, and that's what hedge funds do as well in markets like this. That's definitely one thing.
I think it's interesting you mentioned about position size, Raj. I think one of the key things that we talk about the Institute is your position sizes don't have to be the same at all times. So your position size should reflect your conviction and also the volatility of the market. So typically in a bear market, you tend to have higher implied volatility, which means, and also historical volatility, which means that you can generate the same returns of smaller positions and have the flexibility to trade around a little bit more. So maybe shorten your time horizons with smaller positions.
Right. I think that's absolutely right. And I think you have to look for pairs in bear
exactly.
And one thing you look for pairs more within sector rather than like across just random longs and shorts. For example, like if you've had that long growth short value trade, you've got an absolute cream, even though your gross exposure looks flat, or even if you even if you're net short, but you're a long growth short value, you've gotten beat up on that trade, and hedge funds performance clearly shows that.
Exactly, that's key, the hedge fund problem.
Mm-hmm.
And it's actually interesting you mentioned about this sort of the rotation out of growth into defensives.
Mm-hmm.
You and I both traded through bear markets, Raj. This is not going to take place in 2-3 weeks. This is potentially months that this goes on.
Or years,
Yeah, or even years, yeah, absolutely. So it's yes, I mean, growth is probably looking a bit oversold, like you said, and some of the defensives are looking rather overbought. So there's probably going to be some kind of reversal, but I think maybe the fundamentals may have changed here.
Yeah, and here's one more thing to note about bear markets. It's a lot of you probably never traded through bear markets, except for me and Chris, that the rallies tend to be bigger, greater
absolutely.
in market than in the market.
They're vicious.
Basically, just think of the market you have now, just turn it opposite. Like, for example, in 2008, the greatest percentage moves in Lehman Brothers were to the upside. Like they had multiple days plus over 100%. Obviously, you can go down more than 100% in a day.
Yeah.
So
the squeezes can be absolutely unbelievable.
Absolutely. Yeah, because the core position is short.
Exactly.
And your position just keeps getting bigger as that happens, right? So it's an additional risk.
Exactly, which makes it very painful.
Yeah. What about looking at some more kind of specific ideas? Is there anything that your mentees have been looking at or anything like that?
Sure. You want to go ahead, Chris?
Yeah. I mean, like I said, I mentioned the sort of the consumers staples, which we've been talking about, defensives for a while. I still think like Raj said, retailers, consumers, that's still going to be where the strength is. And given looking at the lead indicators that the US construction sector continues to be weak, and it's probably going to continue to be weak. I think some of the trades that have worked retail against construction is still there. Consumers, defensives, consumer staples, still going to be there. And I think potentially growth is going to be a problem for the next few months. Yes, we're going to have a bit of a bounce, but I think that some of the old leaders could well become the laggards.
Yep.
How about you, Raj? What do you think?
Yeah, I'll highlight one trade that came about from Thailand. One of my students, at the end, you have to present a trade idea, and his was Canada Goose. GLF.
Yeah.
They, if you don't know, they basically they're premium brand of high-end winter jackets, and stock was around 50 at the time of when in Thailand. They had a report yesterday. Stock got as high as like 72. It's trading in the mid 60s right now. Few of my other students are also in call spreads in this name. Call spreads. I mean, as you can see, if you put this data up, we came up with an implied valuation of $84 going forward. So kudos to that. I mean, I'm actually long at 32, but
somebody has to be.
That's okay. But actually, but what's interesting was I actually went to and I confirmed my theory. I was in Chicago this weekend and I needed a coat, so I went into. So actually it was actually just next to my hotel. So I went in. Well, first of all, when I walked out of the store, there were 20 people waiting to get in the store.
Jeez.
Usually a pretty good sign.
Absolutely. That's pretty bullish.
Waiting in line outside to buy $1,000 jackets. And actually, I thought to myself when I'm standing in line, I bought a vest, which is $500.
You're a tough guy. Yeah.
6 people in front of me buying coats. So that's basically $6,000 to $7,000 in line. And why am I? What? And when I'm spending that much money, I shouldn't have to wait in line. But
No, absolutely.
we're falling over each other. So that's generally. And so think outside the box. That's a good way to think outside the box. Walk in those stores.
Absolutely.
But you know what? And like I said on pairs trades, there's like I think the high end is going to continue, but be selective. Like I think that one name that I don't like in the sector is Michael Kors. Like the market, they just bought Versace. If you don't that Versace is not a premium brand anymore.
No, it used to be. Thinks it is.
Right. Like if you put two former, that's like that would be like running in 2020 to let's put Hillary Clinton and George Bush together and have them run against Trump.
Yeah, that's good.
I mean, really, they're just not neither one's a premium brand. They're not Louis Vuitton. They're not Hermes. They're just, to me, I think like Hermes to me is like, with these bags where like you can't even buy a bag.
No, absolutely.
Like Hermes is kind of like Baywatch, like Pamela Anderson from Baywatch.
Yeah. Okay. Cool. Yeah.
And Versace's more like the current version of her that like Julian Assange in the Chilean whatever. Yeah. She's giving booty calls to Julian Assange, who's so
that stock's definitely up its highs. Let's put it that way.
Yeah, absolutely. That bubble's burst.
Yeah, definitely, and it's going one way. So I agree with this. So the consumer's still there, but it's got to be differentiate within the sector, and probably a little bit more intra-sector trades is probably the way forward in a bear market. Actually, just talking about sort of a potential bear market. I mean, just to touch on a few things that I've been thinking about going into next year, 2019. That just a few bits of information which start to sort of worry me a little bit and see not quite actionable trades yet, but just to sort of get a backdrop that further raising interest rates, obviously, another one's predicted in December, so in a few weeks. And the market's looking for another 3 in 2019, which is kind of again late stages of a bull market. But just to put a few numbers onto where the US bond market is at the moment, right now, the US corporate debt is 6.3 trillion, which is about 45% of GDP, which is kind of around about the peak. So this is where it was in 2001. This is where it was in 2008. And kind of we know what happened when the tech bubble unwound and what the housing bubble unwound. Let's see what happens going forward. But clearly it's a bit of a red flag for potential recession at some stage in the next probably 18 months in the US. Consumers even more leveraged than it was in 2008. Consumer debt just went through the highs of 2008, which is again a worrying signal for potential the US going into recession. And we've got the high yield market, the free cash to debt ratio is around about 12%. Put this in context, in the peak 2008, this is around about 14%. So high yield junk bonds, the amount of cash to cover their leverage is below where it was in 2008. So there are potential warning signals starting to crop up, which is potentially going to be some trades next year rather than this year, I think.
So does that mean that you're looking at stocks with good sort of with high cash and low debt? Is that the play basically?
That would be on the long side, sort of cash rich, not particularly over leveraged. On the short side, clearly very cyclical companies with high degrees of leverage. Just a sort of trade that everybody's talking about. We're talking about sort of the leadership of the market, and Raj has been talking about growth. That just a Netflix outperformed Disney by 35% this year. A lot of people have been squeezed, trying to be short Netflix. Maybe Netflix, given its debt to equity, is rather high relative to its competitors and about 4 times what Disney's is. I think that potentially Disney's going to go after Netflix, and that may be a trade to be long Netflix, long Disney, short Netflix in 2019. But let's see how everything plays out with the implications of the Fed and how these companies refinance themselves.
Yeah, that's been a bit of a pain. Netflix until recently has been
absolutely
pain trade.
It's been a big pain trade. Too many people try to short it, which is dangerous.
speaking of pain, let's talk about oil and natural gas.
Oh yeah. Oh yes.
I mean, it's amazingly, oil 6 weeks ago, it was at a 4-year high, and now it's in a technical bear market. I mean,
that is unbelievable.
And honestly, for me, I always have trouble trading the price of crude because, like, to me, when you're trading on the whims of like OPEC and countries that kill journalists and oligarchs and Trump, like these aren't exactly like a cast of characters that are the most trustworthy. So
absolutely.
So, having said that, I still think that names like the E&P names like Halliburton, Schlumberger are pretty cheap, and buying call spreads and puts in to finance that. But the real pain, really, in as painful as that been, I think the real pain for a lot of hedge funds and really other guys here has just been the natural gas trades. If you haven't, it's up. Like I bought some UNG in my portfolio last month, and not because I'm a genius, just because I thought, number one, if crude continued to rally, it has to drag natural gas with it a little bit from its low. It's up 60% from its low in September. And
60%.
Clearly a short covering trade, but it was and if you haven't followed, this is the most amazing thing. The reasons that they're calling for it is, wait for it, there is going to be a cold winter.
Wow, that is genius. It's going to be a cold winter.
Winter. It's cold. It is cold right here. By the way, it's going to snow here in New York, so maybe we'll continue to rally, but that's not a reason to buy it.
So some people get paid to tell you it's going to be cold in the winter.
Right. But in all seriousness, they're saying, with all seriousness, like the other stories, they're talking about stockpiles with the lowest since 2005. But if you've been doing your homework, like production's been the highest in the last 2 years. So there's plenty of natural gas. It's unless it's like unless we turn into the unless the Midwest turns into the North Pole this year.
Yeah.
And then that price of natural gas is probably too high. But having said that, I do think there are the names itself, just like in the E&P names in oil, are cheap. There are some names. I've been buying calls in. I sold out my UNG, but I have been buying calls in a couple names that I do like. I like EQT, but I think that one's a little hard to trade because there's just a corporate action. They split the company, so I need to get that out, and that'll be a little hard. If you look at it, you're like, oh wait, why is it down 50%? But that's what's happened there. But more pure plays, I also like COG, Cabot Gas, and Chesapeake, CHK. Those are ones that I think that on an E&P basis, they.
Yeah.
I don't know if they have explosive upside, but they probably have less downside. And again, it's back to value names. I think they've been so beaten up. They potentially have some upside. But again, don't go out buying these names just because it's cold when you got
because the winter.
If you're in the middle of Times Square, like it's freezing, it's like, oh, I'm going to buy some natural gas. That's not that easy.
Unfortunately, it's not that easy, is it? Yeah.
No.
But it's funny actually. Sort of mentioned this at the time of the year and stuff. I mean, a lot of feedback I've been getting recently is just mentioned that seasonality of the market and how the market goes in different stages and performs differently during the 12 months of the year. Mm-hmm. I think we're sort of talking about potentially the end of a bull market or the late stages of a bull market. I think possibly call the top, but it's something to bear in mind. But traditionally, November, December are not great months to be short.
Yeah, Santa
Claus Valley. Nobody wants to short Santa Claus. So, I mean, yes, you can look at what the price action at the moment. It's not particularly bullish, but is it right to be fully short, or is it something that you probably ought to be thinking about going into 2019?
Yeah, right. And another thing they talk about is instead of seasonality, there's just less trading this time because investment banks, everyone's trying to protect your bonuses.
Absolutely, everybody's trying to protect.
So we don't want anything. Everyone's trying to make money in Q1.
Exactly. You don't. Your risk score is massively skewed against you there, an investment bank or a hedge fund right here, right now.
Exactly. In December, your best goal is to be flat. Don't make money, and just like all the money that you really made, just put it on the drawer.
Exactly.
Have it magically appear next year. Oh look!
Oh, great first quarter.
How'd that happen?
Yeah, exactly. Where did that come from?
What a good start to the year.
Yeah. So I think we're in a sort of potential inflection point. I think we've got a lot of opportunities going forward, and I think you just do the work and come up with ideas. But just remember, we may be in a bear market, so like Raj says, keep your position sizes accordingly.
Cool. Well, I think that's all we have time for on this episode. As always, great speaking with you, Raj and Chris, and I look forward to catching up again in the near future. I just want to remind you guys watching as well, as always, as I said at the beginning of the episode as well, that if you want to learn more about trading, more about what the Institute does in general, then do visit our website, itpm.com. There's a lot of different links to educational resources up there. So things like our live upcoming seminars, the ones that I mentioned at the beginning of the episode. So those are in Gold Coast, Australia, London and Florida, all upcoming. We've got bite-sized videos up there. We've got the core video series as well that we sell. So those video series about teaching you how to construct your own sort of global multi-asset long-short portfolio. And then our kind of flagship mentoring programs, which are all about teaching you what you learn in those video courses and applying them to a kind of real-life live situation, managing your own money. And guys like Raj and Chris help you through that. And previously, we've seen great results with students who have gone on those programs, really accelerated their learning and helped them generate better returns a lot quicker. So with all that being said, thanks very much for watching the show, and make sure you join us next time for another episode of What's on Your Mind.